Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers on this Thursday, June 11th, 2026. We've had quite a bit of data to sift through from yesterday, June 10th.
That's right, Ethan. Our AI flagged quite a robust list of names from social media discussions, with a significant number of posts across a diverse set of companies.
Yeah, it feels like the market's really buzzing, doesn't it? We saw a lot of enthusiasm, especially around the tech sector, hinting at some exciting growth stories.
Well, you know me, Ethan. While there's definitely a buzz, the data also highlighted some very clear concerns and significant red flags for a few names. It's a mixed bag of potential and peril out there.
Absolutely, Brooke. Let's dive right into our first lead for today, SAP. Now, the sentiment here is strongly bullish, which is great to see. Users are really emphasizing SAP's fundamental strength, seeing it as significantly undervalued. They talk about its sticky customer base and how it's an indispensable transactional system, almost immune to what some call the AI hype that's distracting the market.
Sticky customer base is great, Ethan, but I'm looking at the KPIs. Its current price is at 170.3, which is, well, pretty close to its 52-week low of 158.58, and a long way from its 52-week high of 313.28. While that might suggest undervaluation to some, we did see Goldman Sachs lower SAP's gross margin forecast due to rising hardware costs. Those past downgrades mentioned by users, they have real-world impacts on profitability.
Fair point on the hardware costs, Brooke. But a PE ratio of 24.86 for a mature tech company with a 6% revenue growth, those healthy net profit and operating margins, they still suggest a fundamentally sound business. The news also points to SAP's BSI cloud approval and their AI plan. That's a clear strategic focus on integrating AI, which could definitely improve future KPIs. This isn't just an old reliable car, it's getting some serious upgrades. We've rated SAP as a buy twice recently, on May 20th and June 1st. I think that stands.
I'll concede that the margins are healthy, and the low current price could be an entry point. The AI initiatives do have potential to drive future revenue and profit, but we need to see that materialize. For now, given its established strength and potential for a rebound if these AI plans take hold, a buy classification is warranted, but with an eye on that July 23rd earnings report.
All right, moving on to Advanced Micro Devices, AMD. This one, well, it's generated some really interesting, if not concerning, discussions. There's a post talking about AMD funding a startup, TensorWave, with $350 million, seemingly just so they'll buy AMD chips. Some users are calling it DIY revenue. DIY revenue is a generous term, Ethan. The sentiment is heavily bearish, with users drawing stark comparisons to the dot-com bubble, where companies vendor-financed hardware to startups, leading to defaults and market saturation. One comment even called it a Ponzi scheme. When you look at the KPIs, a PE ratio of over 151 is astronomically high, indicating massive growth expectations that this artificial revenue strategy might not sustain. I see what you're saying, but other companies, even NVIDIA, make strategic investments to build out their ecosystem. And some news did highlight AMD's genuine growth in AI infrastructure. Plus, there were insider purchases of nearly 290,000 shares over the last 6 months, which typically signals confidence. The revenue growth is almost 38%, which is nothing to sneeze at. Insider buying is good, but that debt-to-equity ratio of 6.005 is a serious concern, especially if these strategic investments don't generate genuine profitable returns. The stock's current price is $452.4, significantly off its 52-week high of $546.44, and news reports mention a recent chip sell-off. The market already seems to be reacting to some of these qualitative concerns. Our previous rating for AMD was a stay away yesterday, and frankly, nothing in this discussion improves that outlook. This high-leverage, high-valuation strategy, when combined with such skepticism, makes it a clear stay away. Next up, we have Oracle Corporation, ORCL. Oracle announced it foresees raising $40 billion through debt and equity financing. Now, on the positive side, they did report record Q4 and FY 2026 results, beating earnings and revenue estimates, thanks to cloud growth. And they've got this massive $638 billion backlog. That backlog, Ethan, is what I'd call a mirage. Over $300 billion, more than half, comes from a single customer, OpenAI. If OpenAI falters, that backlog evaporates. Furthermore, users are alarmed by the $40 billion financing plan, especially the equity component, which means dilution. Their existing debt-to-equity ratio is an astounding 415.265. That's not just massive debt, as users put it. It's a crazy debt structure. Well, a huge backlog, even with a large portion from one customer, still shows significant demand for their services, especially in cloud infrastructure. And they're growing revenue at over 21% with healthy profit and operating margins. They clearly have a strong underlying business. But the discrepancy between return on equity and return on assets clearly shows that high ROE is largely debt-fueled, not pure operational efficiency. And they provided lower than expected Q1 guidance and an unchanged FY27 outlook, which directly led to the 5% stock drop. Our AI has consistently rated Oracle as a stay-away, including just yesterday and the day before. This new financing plan on top of existing debt and a fragile backlog simply reinforces that. It's a definitive stay-away. All right, let's talk about Super Microcomputer, SMCI. There's been a lot of chatter, with the stock dropping 28% today. But I've seen some users still bullish. One post made a strong case for SMCI becoming an AI factory builder, targeting 12 to 16% gross margins and projecting over $40 billion in revenue next year, backed by $39 billion in orders. Plus, insiders bought nearly 800,000 shares over the last 6 months, which is a powerful signal. Ethan, the community sentiment on SMCI is overwhelmingly bearish and riddled with skepticism, regardless of any bullish thesis. Users are calling it a sketchy company with a history of cooking their books and fraud. The volatility is ridiculous, as one user put it, with wild swings and a tendency to drop a bomb after peaks. Its beta is 1.869, confirming that high volatility. The debt-to-equity ratio is over 120, and the net profit margin is a meager 3.7%. That $7 billion financing that news reports mentioned, it's causing massive dilution fears. Our rating for SMCI was stay away yesterday, and this new data, especially the community's deep distrust, only confirms it. It's a clear stay away. I hear the concerns, Brooke, but the potential upside if they do hit those AI factory targets and leverage those massive orders could be transformational. Those insider buys are not to be ignored either. It's a high-risk, high-reward situation, no doubt. High risk indeed. With a low net profit margin and the persistent allegations of financial misconduct, even massive revenue might not translate into sustainable shareholder value. It's too much of a gamble for a long-term position. It's a clear stay away for me.
Finally, we're on to NVIDIA Corporation, NVDA, another stock with significant community buzz today. The overall sentiment is bullish, with users reassuring each other about the company's strength despite recent dips. They're calling it the most valuable company in the world and the best company to bet on. Long-term holding is a popular theme. News highlights continuous innovation in AI, strategic partnerships, and major data center agreements. And get this, insiders bought over 58 million shares in the last 6 months.
It's true, Ethan. The community and news are very positive. NVIDIA's revenue growth at 85.2% and net profit margin at nearly 63% are absolutely outstanding. The PEG ratio is 0.64, which suggests it might be undervalued relative to its growth, even with the PE of 31.86. Those insider trades are a significant positive signal, too.
Exactly. It's a testament to their market leadership. While the current price of 200.42 is below its 52-week high of 236.54, it still leaves room for upside, and users are confidently predicting a rebound to 230 in the near future. It's truly at the forefront of the AI revolution, and that's a powerful driver. Our AI has rated NVDA as a buy several times recently, including June 3rd and 4th. I'm upgrading that conviction.
I agree the numbers are compelling and the strategic positioning is undeniable. However, we should note the beta is 2.202, indicating high volatility, and its debt-to-equity ratio is 6.555. So while it's a powerhouse, it does come with some inherent market risk. But given the overwhelming strength in growth, profitability, and insider confidence, I concur. Buy. Investigate as buy. SAP SEADS. NVDA. Investigate as cautious buy. None. Investigate as speculative gamble. Super Microcomputer Inc.
All right, that wraps up our daily hunt. What a dynamic day in the markets.
Indeed. Remember, navigating these waters requires constant vigilance and independent thought.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in to the Daily Hunt for Multibaggers. We'll be back tomorrow with more AI-generated insights.
Until then, happy hunting!